which we can't seem to get over. We're going to get stuck into the webinar this morning. Thanks, everyone, for joining. And as usual, before we get stuck into the content or the topic we're going to talk about today, which is Division 7A, what to do about it, how we solve them, those things that pop up. We're going to get into a brief overview of other things that we've got on, and here we go. So our next webinar is next Thursday on the 2nd of November. We're going to be talking about restructuring your business structures. And what we're talking about there is companies or trusts, not strategy, business strategy. This is the structure side of things. So the legal entities, that sort of thing that run your business. Talking about, what do you, if you're at a point where you want to change them, account for growth, arrange for a bit of a management buy-in, how do you go about that? Or even, certain employee incentive programs. So we're going to be talking about that in detail next week. Restructures are we'll talk about it later in the webinar today, but they're a potential thing that may help Division 7A issues as well. So quite kind of related. So thanks, Tay, for popping the link in the chat box. If anyone wants to register, a link's there. Now, the day after that, which is pretty exciting, MP, I don't think you've registered. I could be wrong, but I don't think I've seen a registration. But we've got our 10-year anniversary party and a book launch in one night, and a bit of a Christmas celebration as well, even though it's very early for a Christmas party. 3 in 1. It's going to be an awesome night down at the just above Felons Brewery at the hotel that sits on the wharves there. If you do want to come along, that QR code, or I'm sure there's a link. Thank you. Thanks, Tay. Link in the chat box now if you want to join. Good to see you, Mr. Hardy. And you are more than welcome to join at that party too, if you can make it. Cool. All righty.
We should mention as well for the registration for the 10-year anniversary. If you are clients of ours, it's not $200. It's that's included. Come and just join us. But yeah, if you're a fan of us, you've seen our webinars, you want to come say hello, feel free. We're keen to see you guys as well.
Beautiful. All righty. And the book that's being launched on that night is called It's All Sorted, which is on the screen right now. So it's a 9-step guide I've written to master your tax and achieve peace of mind. It does actually include things like Division 7A and how we manage them in the book as well. But lots of information on basic to intermediate and advanced tax strategies and tax saving strategies, along with a whole lot of info on structures as well. And I'm pretty pumped about that being released, and should have a whole heap of books in the mail arrive any day now. So if you do want to get a heads up on when that's ready to order, just pop the word book into the chat box, and our team will just make a note that you want to be notified, and we'll get you that link if you're keen on that. And in the spirit of more books, the Wealth for Life, which I published just over a year ago now, that is also available for purchase from our website if you are keen on that. And we talk a little bit more about growing wealth as a business owner and things you need in place to be able to do that effectively. Alrighty. And then a brief introduction to Inspire, if you haven't already known of us. So we're an accounting firm based in Brisbane in the Fortitude Valley, working with small businesses around Australia. One of our key things we do is keep an eye on making sure our clients aren't paying too much tax or no more than they need to. And to date, our tally of tax savings is over $28 million, which is pretty high. And 10 years into business, it's pretty unfathomable if I rewound the clock a decade to think that would be the case. So it's pretty cool to see happen. And in terms of an intro to me, 10 years ago, or just over 10, I kicked off Inspire when I was 23 years old. Oh dear. I'm an award-winning chartered accountant with over 17 years accounting experience, author of Wealth for Life, and literally in the next couple of days, it will also be It's All Sorted as well. And Riz.
Yeah, I joined Inspire back in 16. Moved here all the way from Malaysia and fell in love with Brisbane and decided to stay. Excuse my raspy voice. I'm just getting over a bit of a cold here. And yeah, I've just been looking after quite a big set of clients, and it's been growing over time. And I've been able to provide some insights and share some tax saving tips that's helped some of our clients save up to 2.2 million in 2023 alone. So it's been a really rewarding journey. And yeah, I just recently became a new dad, one of my proudest achievements. And I'm on a mission of shedding some keys and kilos in weight. So if you do ride Peloton, feel free to add me at Rizal Ramzan. We can go ride together. But enough about me. This is all about you guys and what you guys can take out out of the session today. So there is a bit of an overview in the next slide we'll go through in a bit. But if you do up to this point, if you do want to have a chat, we'll shoot this link up to you guys. You can book a call to have a 20-minute chat with us, just to kind of dive a little bit deeper from some of the stuff that you want to talk about today as well. So yeah. If you want to, if you're a current client, we usually have a bit of a mix on these webinars. If you're a current client and you have Div 70 issues, or you want just a review, obviously just book in with your Inspire accountant. We'll have a quick chat there and then take the next steps. And obviously, if you haven't worked with us or you want to work with us, you want to explore a little bit more, we can do a bit of a review of your current Div 70 situation, specifically under that look under the hood service that we provide. But yeah, book a call if you want to. So I'll just take a little bit of time to give you a bit of overview what we're going to run through today. So there's kind of three main bits here. One is the basics of taking money out. It's fundamental and it's important to understand this because it just depends on how much knowledge you have in the structures that you use. But what we found in the past is this gives us a solid knowledge on understanding the next bit, why Division 7A exists. So when we talk taking money out from your business to yourself. So we'll go through that, and then we'll talk about why Division 70 actually exists and when it got introduced and kind of rules around it. And lastly, what you guys are here for, obviously the solutions. We break it down to kind of short, medium, and long-term solutions for Div 7A. And yeah, it'll be some interesting parts. And if you have any, and in the end, we'll have some Q&A as well. Just a quick note at the bottom there. Obviously, it's not a cookie cutter solution. It depends on the size of your business, the different income level, wealth position, cash position, goals, etc. So it is a bit general in a sense, hence why I do recommend you guys booking in a call with us if you have further questions that you want to dive into. Cool. Do you want me to take through this one, man? So you can have a little bit of lunch too?
Yeah, I like this. I'm just the slide clicker. That's good.
Yeah, awesome. So we'll take you through the basics of taking money out. Now, in terms of the types of structures that we have, and on the next slide is that we fundamentally we have companies and trusts. We also have sole traders or individuals, and self-management funds, but we're not going to focus on that today. Primarily, it's about how to take money out from your business, and we usually see a business being run through a company, which is that triangle, and then a trust, which is that rectangle there. Now, there's three ways to pull money out of each of these structures. Now, the first two, the first one is the same across the two structures. So you can see 0.1 on both under those arrows there, next to the arrows. You see that salary is the first way you take money out. Now, this is a pretty straightforward way of taking money out, but it comes with a bit of condition. Because it's a salary, the main two things is that you have to prepay some tax on it, PAYG withholding or pay as you go withholding taxes. That's the one that you pay in your BASs. If you have employees, you pay the taxes on their behalf. That's the one that you withhold and pay to the ATO. If you take a salary out as a business owner, that's what gets paid as well. And then you also have to pay super on top of that salary. Now, I think that's at 11% now. And so, yeah, we just need to change that. It's going up. It's been going up in the last kind of couple of years. But yeah, this slide, I think, is pre the change. But it is at 11% now. Now, the reason why we say these are conditions is this is mandatory. There's no negotiations about it. If you pay salary, you have to do it, even if it's to yourself. So there's kind of arguments on why you would do it and why you wouldn't. That's a whole other tax planning kind of topic that we can go through at a later date. Now, the second point under the company, which is the Div 70, that's what we're all here for. We're going to dive deeper into that and why it exists a little bit, but that's one way to do it. Effectively, it's just pulling money out, and you're not being taxed on it. You're borrowing that money. That's why it's called a loan. Even though it's money that you control, a bank account, you control, you're transferring to your own bank account, it's still considered a loan, because a company or a trust, where there's a trustee involved, it's considered a separate legal entity. So you are borrowing from this separate legal entity. And we'll talk about the Div 70 provisions in a bit. Now, the third point, dividends. Now, as a company, you have to think of it as like a bucket, all right? So each year, it will do its thing, run its business, make some income, minus some expenses, you've got profit. Now, when you have that profit, usually what you have to do as well is pay tax on that. So there's a 25% tax rate for companies that are small businesses. And once you pay that 25% tax, you get what this thing called retained profits, or profits after tax. Now, you do that for a couple more years. What happens is you keep retaining more profits, hence why the analogy of a bucket. So there's retained profits bills in the bucket year on year. So one way to empty that bucket, imagine a tap at the bottom of that bucket, that's a dividend. So you open that tap up, you flow those retained profits out from the company, and it flows through your shareholders. So it's important to understand who are your shareholders in your company. It's a hint for tax planning a little bit. We won't go through too much in today, but there will be parts of that we'll talk about when we talk about the solutions later. So there's three ways for the company. Now, for the trust, number one, the same. I'm not going to cover that again. You can pay a salary. The second two, the other two ways is a loan as well. But the difference here, if you pull money out from a trust to yourself, it's considered drawings. It's still considered a loan. You still owe the trust the money, but Div 7A doesn't apply when you pull money out from a trust. And we'll go through the reason why in a second. And the kind of short version of it is you're going to end up paying tax on that money anyways at a marginal tax rate, so they don't really worry about that being an issue, whereas a company has a separate tax rate, 25%. We'll dive deeper into that in a second. Number three is distribution. So we talk about current year profits. Now, this is the key difference between a company and a trust, and this is kind of spiderwebbing into structure chats a little bit. But essentially, if a company is a bucket, a trust is like a funnel. So any money that comes in that current year, it doesn't retain. It doesn't stay in the trust. It flows through like a funnel. Where does it flow through? Instead of shareholders, it's beneficiaries. So if you have a trust, you'll have a trust deed. The trust deed will identify who your beneficiaries are. And essentially, whenever you finish the financial year, you should be doing a trust distribution minute to make sure you distribute any profits that's made in that year to your beneficiaries. Now, here's the tricky thing. The beneficiaries will receive that current year profit, and then they will be taxed. Now, who are the beneficiaries? It can be an individual, or it can also be a company. So that's where some Division 7A implications come in, where you have a corporate beneficiary, a company beneficiary, or you might hear bucket company if you have something like that. So we'll go into that as well in a little bit. But that's a bit of an overview. And we'll go to the next bit, and I'll let Ben explain why Division 7A exists.
Cool. Thanks for giving me a quick chance for lunch. Alrighty, so why Division 7A? And this, I guess it was a bit confusing to me before I sort of understood why it was brought in. But let's imagine we've got a $1 million profit in a year. Now, if we give that to an individual, option one, just pay it all to an individual, or the individual earns that income, where we're looking at most of that being taxed at the top marginal rate of 47%. Tax. So the after-tax amount in an individual name, again, this is ballparks. Not every dollar will be at 47%, but ballpark 530K after tax. And then if we compare that to a company, so if the company earns that business income, it's taxed at 25%, and the after-tax profit left in a company is a lot higher, 750K. Now, if we look at that, it's pretty clear which option anyone would want, unless you like giving money to the government. And so Division 7A exists and I guess it's because if we leave money in companies to be taxed and then we take it out without ourselves getting taxed on it, that's generally how it happens. So why would you need money out of a company? Let's say, like, let's imagine all that business income went into the company, and we had $0 taxable income in the individual. We would very rarely have a situation like that, but just bear with me for a sec. You need to pay living expenses for the person. A mortgage needs to be paid, or rent. You might buy a property, make other investments, any other lifestyle expenses as well. So I guess the question is, how are they going to get paid? And so what Division 7A wants to stop is people just ripping cash out of companies at a 25% tax rate, and spending it personally, where they would otherwise be taxed at 47%. And just to illustrate that again another way, we've got a figurative person here called Clyde Palmer, no relation to Clive Palmer, and his love for boats. But after a few years building cash in the company, so Riz mentioned those retained after-tax retained earnings. So he's paying tax at 25%, it builds up, and then he wants to buy $1 million boat. So he takes the $1 million out of his company as he just takes it out as a loan, buys a boat in his personal name, if we ignore the requirements of Division 7A, the ATO deems that all of that money, the $1 million, is a dividend, an unfranked dividend to Clyde if he does not meet the requirements of Div 7A, and he's taxed at the equivalent in his personal name, so 47% tax. So not only has the company paid 25% on it, he'll get taxed at 47% on that $1 million when it comes out as well. So not a good situation. Just to come back to because I guess a question comes up a lot from clients. Well, how did the loan come about? And it's basically it's a difference between what you've been taxed on personally and what's been taxed in the company versus what you've taken out. So if you've been taxed on 200 grand, but you've taken out 400 grand, rough figures, you're going to owe 200 grand back to the company. Common things are, living expenses, whether they're high, that could be high. People buy investments and forget that they, ripped 100 grand out of the company to go and fund something. Or it could be lifestyle expenses as well. They're the common reasons why we would have this Division 7A loan. And I've got to say, it's not all bad. It's not like if you have one, you've got to freak out or anything like that. They can be managed, but they have to be managed to make sure you're compliant and we don't have any adverse tax implications. Sure.
And if I might add, Ben, just to slow down on that part as well, to kind of really land that bit, where did the Div 7A, where did the money come, where did the loan come from? There's also situations where people went, I want to keep my income low, my taxable income low, and I want to kind of save tax because I want to keep my income low. So what they do is they pull a small amount of salary or a small amount of dividend in their personal name, but their living expenses is beyond what they've actually pulled out. So that's where push comes to shove, they still have to pay for their home loan. They pull money out from the business. So that extra top up, that difference there, can become a Div 7 loan if not treated properly, or if we don't have a plan for it, essentially. So I think the fundamental issue here is that you need to almost work backwards first. Like, what do you need in terms of your living expenses and your lifestyle? Now, no judgment whether it's $1 million a year or 500 or 250, doesn't matter. Whatever that money is, what that amount is, that's the amount that you probably just want to take out personally. And the reason why I say that is you're not going to be able to pay it back. It's not an investment. It's not something that you can return. It's in a way, in another analogy is to think about it is if you don't take it out personally and get taxed on it, you borrow for it. It's kind of like living on a credit card in a sense. You're just kind of racking up this debt and that you'll never get to pay back because it doesn't make income. There's no return of capital or anything like that. So working backwards from your living expenses first really clears a lot of things up usually, and then after that we can decide, all right, how much of that how much of the extra money do we want to take out for other purposes like investments and things like that.
Yep, that's it. And I guess just to sort of cover on the broad rules of Division 7A, this was introduced in 1997, so it applies to loans that started after that point. And when we work with clients, I haven't seen one in a very long time that started before that. It's been a while. So the other requirements is loans need to be documented. Then there's principal and interest requirements, or repayment requirements. There's a maximum term as well. The interest rate you must apply is dictated by the ATO as well. Currently, that is 8.27% for the current financial year. That is literally 73% higher than last year. The main reason for that, of course, is the cash rate has been going through the roof. And the way that the ATO does this is uses the cash rate as a benchmark and applies some sort of markup to that to work out what the Div 7A interest rate has got to be. Now, most Division 7A loans are going to be unsecured, where you've got 7 years to repay that loan. And then we've got also the option to secure a loan, but you must secure that on property. And there's other certain requirements for that. But if you do that, you've got 25 years to pay. And that actually can be a good medium to long-term solution for these loans. This is an interesting point. Sorry about that weird laugh. But it also applies to distributions from trusts to a bucket company that hasn't been paid in cash. Now, this is an interesting one because the ATO has very recently lost a court case where their position was any amounts that a trust owes a bucket company as an unpaid distribution, they saw as a Division 7A loan within a certain time period. They've just lost a case that they could argue that, and I have a very strong feeling they're going to appeal it. So at the moment, that's a bit of a question mark of where that sits right now, which is quite interesting. And
interesting for you and me, maybe, but it is interesting overall, right? Like it is a point. It's one of those things that it changes the fundamental advice that most accountants will give when it comes to distributions to bucket companies. So that's something that we want to be keeping a close eye on. But it is a very contemporary topic. So interesting point in that one.
It is. Alrighty, so let's get into some solutions. Riz, are you right to do the first short-term solution?
Yeah, and the reason why we break it down to short to medium term is there's because one thing that we want to identify straight away is, do you have a Div 7A issue? Now, if you have one, you need to at least get onto the short-term solution first. And then that is essentially have a chat. Because if you leave it alone and you're non-compliant, there's a risk that you're going to be taxed quite a lot if you don't deal with it. So as the solutions go from short to medium to long-term or permanent solutions, it gets a bit more complex. But at the start, please just at least have a conversation around it. Make sure we have a plan in place while we work towards a longer term solution. So one of the things that people do as well, they always take the cash out to put it on my offset, right? I want to take the cash out, and then what they do is they move it before 30th of June. Now, the ATO has come up with kind of guidance around this and saying that, look, if that's consistently done every year, and also it's big sums, literally 30th of June, 1st of July, right? Like you keep switching that around like that. It is taking piss a little bit, excuse the language, but they're saying they can treat that as a non-repayment of the loan. So effectively, you've been building loans over the years. So, but what we need to do is make sure we identify those loans. I know there might be some legit reasons where you take money out in the financial year and then return it next year. There might be actual legitimate reasons to do that. And it's just about understanding what that is, what that looks like, and moving that money over time back to the business. Because and as long as you do that, and the reason why people do this, by the way, is because a Div 7A loan doesn't crystallize until the end of the financial year. So you could borrow money kind of within the financial year, and then as long as you pay it back before the next tax returns is lodged, then it doesn't really qualify as Div 7A because it's a short-term loan that you've paid back. So people use that as a bit of a, oh, well, if I just do this dance, I can kind of circumvent the Div 7A. Now, if it's blatant, obvious, you do it for that purpose, then we want to be mindful. More importantly, we want to have a longer term strategy, because ultimately you want to get the same outcome still. You still want to be able to offset your loans, but the part that we need to balance out is how much tax you pay if you did take it out. So that's the last dot point. You need a tax effective strategy for a medium or long-term solution. So moving money around, you can repay that back quickly, but it will ultimately end up in a place where we need to look for medium or long-term solutions.
So,
Yeah, did you want to do this one?
yeah, I can jump through. Yep. Alrighty. So, what about some minimum term or mid-term solutions? The sort of really simple and easy one is to pay the minimum repayments on a unsecured loan. So what that looks like is documenting the Division 7A loan, making sure that your accountant is calculating what the minimum repayment is each year, what's due, and then actually making that repayment. And that can be made in, I don't know whether I've got it listed out. Yeah, in cash, or you can pay dividends. But you can issue dividends, but not actually pay them in cash. So just offset a loan. Similarly, with your salary, you could say, oh well, if the repayment's 10 grand, allocate yourself a 10 grand net of tax salary, but don't actually take it in cash. Just offset that against the loan that's owing to you. So there are a couple of ways that we can manage those. Another way we can is cascading loans. So let's say you take out 100 grand in year one, and then another 100 grand in year two. What we don't want to do is put that second 100 grand under the first loans thing. We can have that cascading loan, or one for each financial year, as long as we're meeting the minimum repayments on all of those loans. And there's literally a formula to calculate what those minimum repayments are. But again, that's usually something the accountant advises on and helps you with, usually throughout tax planning each year, making sure you're meeting those obligations. And then the other thing is, essentially build up the loan knowing that you've got dividends that you're able to issue later as a repayment. So, where we see that is if clients bought a large asset in a year, maybe they bought a family home or a big investment property or something like that. They've needed cash in a certain year, but they know that over the next couple of years, they're not going to be pulling that sort of money out of the business. They can leave some cash in companies and also pay dividends out to meet those repayments or to clear the loan. So that's handy. Also, we've had clients where they're going through a business sale or retirement. We haven't prioritized paying back those Division 7A loans more than what the minimum requirements are, because we know we've got dividends coming once they sell the business, that they're not earning business income anymore, and they're able to issue dividends back to themselves personally as those loan repayments, and often collecting a nice refund of those franking credits as a result. So there's a couple of mid-term, medium-term, short-term solutions. Now we switch gears into long-term.
Excuse me. Yes, and yeah, when we look at those medium-term solutions, they're effectively just kind of like borrowing and making sure you make repayments. Another way to think about it is treating that company, whether it's a bucket company or a trading company, as a bank where you make those minimum repayments back to the company. Now, I just want to add that we've seen the interest rates have gone up now, but we've seen in the past where that has been done very effectively, and that's through using it as almost like your own family bank, because you got all this cash sitting, that you've paid 30% tax on, and you want to invest, and you might want to borrow and essentially leverage that investment from your company itself. That's okay. You can do that as long as there's an agreement. It's all fine and dandy. So the longer term solution or permanent solutions, in a way, is thinking about how do we get rid of the loan, or to basically pay it back in full, and we don't have any minimum repayments anymore. Dot point one is very obvious: pay the cash back into the company. So if you have the cash sitting somewhere, or you've realized the investment that you were using this leverage on, you pay the money back into the company with all of its interest, of course, and also its principal. But that's not available to everyone, because sometimes you're illiquid outside, or you've used that cash for emergency reasons, whatever that looks like, historical living expenses. So that might not be an option. So the other solution, which is permanent as well, is paying the top-up tax. So Ben mentioned before, you can instead of paying cash into the company, you can actually issue dividends out. That's one way to do it. But if we're talking about hundreds and thousands of dollars of Division 7A, then it's going to be expensive, because what happens is, like I mentioned before, in the bucket company, or in the bucket, there's retained profits where tax has been paid, which is at 25%. That sits there as a franking credit. Now, when you issue that as a dividend and you receive that personally, this is the differential in tax environment. We've got 25% in the company, and then we've got all the way up to 47% in your personal names. That's where the top up comes into play. The ATO looks at it and go, well, if you take it out personally, yes, you've pay 25%, but you need to pay the further 22% because you're using it personally. So it can be expensive if we do it all in one hit, if we're hundreds of thousands of dollars. And so you want to be talking to your accountants and manage that, because you may want to still do that, but you can do it over time, right? Rather than all in one hit. Remember that you have 7 years to do that. And if you secure it, it's 25 years. So that's a bit of a tax planning strategy there. Now, the other one to do it is buying shares or manage funds in a bucket company. No, this turn that sentence into invest in the bucket company itself. So what that means is you've taken money out, there's a Div 7A loan, and then you go, well, I have excess cash, I want to invest. What you can actually do is then choose to invest in the bucket company itself. In a way, that's putting money back in, right? So, but it's not cash. You actually invest in ETFs, shares. Now, the idea there, the kind of the drawback of this strategy is that you need to find shares or investments that are not capital growth related, or the purpose of it is not capital growth. The reason for it is you lose quite a big benefit when you invest in shares in a company, or if you make capital gains in a company. That's that 50% CGT discount that you have, which means you get 50% off your capital gains. It doesn't get taxed. In a company, you don't get that. So there's a bit of drawback there. That's why the focus is, if you did do that, you want to aim more for shares or investments that create income, not capital growth. It has dividends that gets paid back, or it has term deposits, interest that gets paid back, so that when you eventually sell or cash out from the investment, there's not much of a tax impact. So the whole time you're still making wealth, you're creating wealth through the income, but it's not the growth, the capital growth is not the strategy there. The fourth one here is to secure the loan as a deposit for an investment property or even your home. So usually what we see in practice is that big sums of money are taken out for big purchases. So because of their big purchases, they're usually properties, investment properties, commercial properties, or even their personal home. Now, the benefit of doing it in borrowing that money is instead of kind of taxing it all in your name, is you effectively have a bigger deposit sitting in a bucket that you can use to then invest. But you got this Div 7A problem. So one of the things that you can do is actually enter into a proper mortgage, secured mortgage on that property, and secure that loan with that company. Now, if you secure it, the ATO allows that you stretch that repayment period from 7 years to 25 years. If you notice, what the ATO is really trying to do here is, if you borrow money from a company, as long as it's in commercial terms, we'll allow it. So if you're securing it over 25 years, that's kind of like a mortgage on a home loan, right? 25 to 30 years, it's secured, it's protected, we can stretch it out. If it's unsecured, it's 7 years. So it's a lot quicker that you have to pay it off. Now, why is that a longer term solution? Things like properties, you might hold it for a long time, especially if it's your personal home. You might hold it for a long time, and you don't want to be paying off part of your home loan within 7 years. You want to align that with kind of all the other loans, which is over 30 years usually. So what you do is you align that loan and secure it, and then it's a solution. It doesn't get rid of it, but it makes that minimum repayment each year a lot smaller. So now whenever you receive income from salary or dividends from your business, you can then take that and pay your home loan, one to, let's say, CBA, that's the monthly payment to CBA, and another one you pay to your own bucket company, but over a 25-year period, smaller repayments. So that's longer term permanent solutions. And I think there's a bit more if we go next.
There sure is. And Riz, I'm not sure whether you mentioned it, but just in terms of investment in companies, we just want to make sure that you don't invest in your trading entity or the company that runs your business, because of the trading risks associated. So ideally, we get the funds into a bucket company that's sole purpose is investment or receiving income from other entities in your group, and then that makes the investment because it doesn't have that trading risk involved. So that's another thing to keep in mind.
Right.
And
do you want to do this one?
Yeah.
Okay,
yep.
cool.
Alrighty. So one of the last ones, which is kind of the usually a very large help for Division 7A purpose, is as part of a restructure. And this can time well where the business is at a certain point, let's say you're wanting to give succession from one generation to the next, or you're looking to change your business structure from what it is, maybe what you started with, to what it needs to be to take your business growth or your stage of growth to the next level, whether allowing for investment or just differences in the ideal structure you're running with. But there is ways where basically a new company or a holding company buys your business or buys your shares, and this depends on your current structure as well. We're helping a few clients through this process at the moment. One I've been talking to, I've said, well, there's generally sort of 3 different ways that this can happen, and which different approach we want to take from a restructure, pros and cons with each. There is a way where you can actually reset the cost base of your business, and through that process, you actually create a loan owing to you from a company at the same time. Also depends on a lot of things, ages, value of business, all sorts of things. But there is ways to do this and restructure without paying any or much capital gains tax as a result. Because even though you're restructuring your business from one of your own entities maybe to another entity, that's still classed as a sale of a business or maybe shares or units, whatever your sort of current structure is. Because one of your entities is making a disposal or a sale for capital gains tax purposes, even though another one is acquiring that. We also got to look at stamp duty exemptions, especially here in Queensland, which still tax or still apply stamp duty on business transfers and the transfer of units in a unit trust, unfortunately. But just an example, a new company buys your business for $2 million from a current discretionary trust that owns the business. That company was a $10 company. It had $10 of shares. So it has to loan the $2 million from through vendor finance or from the trust that sold it. Therefore, as soon as that transaction's gone through, it actually owes that trust $2 million. Now, if we think that's the opposite of Division 7A, where we've got a company owing another entity, the Division 7A is where another entity owes a company money. So this is a good thing for Division 7A purposes. And essentially the short version of that is in the future earnings. So let's say that company continues running the business, and as it earns after tax money, paying 25% tax on what it earns, you can actually repay that loan down of $2 million. Once it hits zero, you've essentially used up your loan that's owing, and then if you continue taking beyond that point, then you've got Division 7A to manage again, but it can be very helpful depending on the circumstances.
Yeah. And just to add there, like another way to put that simply as well is if borrowing money from a company creates a Division 7A, if putting money back into the company gets rid of your Division 7A, this is the same thing, just on a bigger level. You're not putting money in, you're selling something to the company. You're selling a business or a share or something. It creates this, oh, well, since I owe you, you owe me, we can net that off situation. So, and it's a pretty complex, we've tried to boil it down to 4 dot points, but
Yeah.
it is pretty complex. There's so many things that come into play. One of the things that you want to make sure not to get caught up on is that transaction of selling something to a company. Like Ben said, it's not just, just because you own the business, you do it without any tax impact. There's a capital gains impact usually, and that's something that we really need to assess. And through that assessment, because it's capital gains, and if you're a small business, you might have access to what we call the small business CGT concessions, and there's a whole process in there to make sure that you can access it. But if you can, that's where we're talking about not paying too much tax on it, and that's where we can minimize it. But it is something that we've seen a lot of our clients go through a bit of growth, and over time their business, it kind of relates to our next webinar actually, Ben. Like their business simultaneously, we didn't just do this because they had a Division 7A problem. Simultaneously, their business actually outgrew the old structure. So running through a trust, for instance, if your business runs through a trust, there's a point where it doesn't make sense anymore. And you want to introduce new investors, for instance. You can't do that with a trust. There's no shares in a trust, so you have to corporatize your business. So in that exercise, you can create some Div 7A solutions as well during that time. So if you're looking at this and you go, well, I've got a lot of Div 7A, I want to do that straight away. I think it's booking a chat first. Let us know about your situation, and we can assess whether it's the short to medium term first initially, and then going into that more longer term and more complex strategy. Okay.
Perfect. All righty. And the chat box has been pretty quiet so far, but just encouraging anyone to pop some questions in to the chat box if you've got them. James has just sent one, and the question is, are there diagrams to help simplify that? We don't actually have them for the webinar, but that is a good idea. For the next time we present this, just to show that a bit more graphically. But yeah, I guess the idea is if you've got a company that purchases a business off another of your entities, and it's basically purchasing it but not paying cash for it immediately, there's a loan owing to that entity it's buying it off. That's the sort of simple way of looking at it. Alrighty. Caitlin's asked, you mentioned that you can take money out of the trust and consider it a regular loan or drawings, not Division 7A. Yes, because it's a trust to, let's say, a person. However, when I do this, it still triggers Division 7A because my trust is overdrawn. Okay, so Caitlin, I'm just not sure on your exact situation, but a loan from a trust to, let's say, an individual, you personally, that does not attract Division 7A. So it's only where a company is owed money. That's where your issue is. So what could be happening is your trust is allocating money to you and a company at the end of the year, potentially, and that company loan is not getting paid. That, yeah, I'm kind of guessing there, but unfortunately, yeah, with the information you provided, that doesn't seem like a Division 7A issue because it's a trust to individual, if that's what it is. Alrighty, Tracy has asked, we have a family trust with individual beneficiaries. Yes, it is possible to add a corporate beneficiary. Yes, it absolutely could be, and that depends on your trust deed. Most trust deeds are written to allow distributions to companies that are somehow related to the individual beneficiaries, but that would be a question for your accountant to review and confirm your deed of whether that could happen. Alternatively, we in situations where it's not able to be done, we could look at exploring amending the deed to add a company on. Hope that helps. All righty. No worries, Tracy.
We've got a few in the chat box here. Let me take some of this ones here. David, did you say at the start that Div 70 does not apply to trusts? It's not that's as simple. You have to think of like where the money is borrowed from and who is it going to. Now, for a trust perspective, it doesn't matter if Div 70 doesn't apply if you're borrowing from a trust and you're an individual. Ben kind of covered that in the previous question. Now, where a trust can come into play, and this is, you need to be mindful of this, is if a trust distributes to a bucket company and it doesn't pay the cash, it doesn't follow through with the cash, that can be a Div 7A loan. Because remember, to simplify is if a company is owed money. So you always have to kind of come back to that. If a company is owed money, Div 7A applies. Next one.
James has a question. If an employee had a loan but is also owed money from the employer, can they sort of offset outstanding wages? That sounds like a bit of a hairy situation to me. So what I'd probably like, it's unrelated to Division 7A because Division 7A applies to entities or people owing money to a company that are related to the shareholder, not at arm's length like an employee. So yeah, and it does sound a touch legally. So what I'd probably recommend there is have a chat to a commercial lawyer to help you navigate that one. Because again, I'm sort of reading between lines there that might be a bit of a hairy situation there, and you don't just want to assume that one can offset the other.
Yeah, and yeah, the point that Ben made, to be clear as well, is the loans that we're talking about Div 70 is to associates of that company as well. So directors and people who are associated to that company. An employee can be anyone. So if the employee is not an associate, doesn't really play in the Div 70 role. It's kind of like just a loan that they owe you and could be considered external debt as well. I'll take next one here. What is the impact of that? Sorry, I just have to read this. There's the impact of 2 companies in a group, both with 2 companies in a group, both with devs and trying to test this. A company also has a loan. Company A owes company B. So just to break it down a little bit, Harold, if there's a loan between two companies, they're not considered Div 7A, but you can't just look at when you look at the group, if there's a loan to an individual or a trust from a company, then that's considered Div 7A. Now, if there is across the group money owing between companies and then money owing between the director and the company, what you want to be doing is just looking at the individual loans first. Now, if those individual loans are legit loans that you want to pay back, you need to treat them separately. So let's say, again, I don't have all the context. Let's say company A and B have loans, but they are legitimate loans. You want to leave it alone because you want that money to be paid back from company A and B. And then there's a loan that the director owes to company B as well. You might be able to kind of offset all of it, but you just want to check that it makes sense from a commercial perspective, because there's some reasons, there's some situations where it doesn't make sense to do so. But as long as there's a Div 7A owing to there's a loan from a director owing to a company, that will always be Div 7A. A bit complex, but Harold, give us a call because there's a lot of things that we need to unpack there to see if it makes sense. Angelo, seriously, is Div 7A required if a family trust with corporate trustee lends to an individual? No, again, from a trust to an individual, no, because the trust is the one that's lending that money across. We've covered that question as well. The company.
Which one are you reading now?
Harold's second question. I'm just yep. There's another one. Yeah. Did you want to take that one?
Yeah, for sure. So as part of a restructure, one option is literally selling a business from one entity to another, and through that process, because you're selling between related parties, the ATO says that you have to do that, or tax law says that you have to do that at market rate, market value, and through that process, when one entity makes a sale, it needs to pay capital gains tax. When the buying entity buys it, it has an established cost base because it's paid money for something. So that's what I sort of meant there with resetting the cost base of the business. If you've started your business without changing the structure, the cost base is often nothing or very little, and that could be a potential to reset the cost base as a result. James has asked if the employee is a family member. Okay, cool. So then loan money from a partnership in a family business. Yeah. Okay. So we're starting to get a little bit. So I can't see any mention of Division 7A or companies there. But if you are lending money from a company to a family member, that is caught under Division 7A. So yeah, it sounds like you might need some specific help there, James. All righty. Riz, do you want to tackle Caitlin's question?
Yeah, done. I think people can read that too, but I'll read anyways. Done correctly, what's stopping people from getting interest-free loans from their business? If they use the cascading loan strategy, okay, and keep offsetting the interest indefinitely.
Yeah. So this you covered this before, is where it essentially the ATO will look at it and says it doesn't count as a repayment.
Yeah, put it simply, guys. If it quacks like a duck, it looks like a duck, it's a duck. So I think what we need to be mindful of is that if you're getting some sort of benefit and you have interest-free loans, like what you say there, Caitlin, the ATO's, that's not the first situation they've seen that. So you will come up against a wall straight away when you're trying to prove that point. So my suggestion is, my answer to your question, Caitlin, is what's stopping them from doing that really is the law. And what's happening and what the ATO has powers over that, because at the end of the day they can still treat that as a loan and they go, well, that's a loan, obviously, and you haven't paid it back, because we can see, there's no interest paid back, there's no money actually being retained in the company at the end of the day. It's the dance that we're doing of moving money in and out. Yeah.
Cool. All righty. And James has asked a question around unincorporated foundations and how they play in structuring of the business. So whether or not a foundation can be a beneficiary of the trust, you need to look at the trust deed for that. And then in terms of management fees from a foundation, so I'm assuming your foundation, you're asking essentially a 0% tax status, you need to be very careful where you're looking at management fees. Yeah, unless it was justifiable somehow, I don't think that could be done. But yeah, in terms of unincorporated foundations, we don't see a lot of them in structuring. In fact, we're not really experienced with them at all, including not-for-profit space as well. So we, in terms of the client base we look after and our knowledge, it's targeted around small business owners and the various structures that they would have.
And there's some really good questions here, and there's some really specific ones as well to your situation. And I appreciate Div 70 usually is like that. It opens up a lot of topics in terms of money taken out or loans owed to associates and stuff like that. What I would suggest is if you do have very specific questions that you want to discuss and see how we can help, book in a call with us, and we'll post a link right now, just so you can kind of access that quickly. And yeah, it's about the details to make sure we get it right. Rush, thanks for posting a question. Can a bucket company have employees that get salaries per members on lower marginal rates? So unpacking that, a couple of things. One, a bucket company, using my own terminology here, a bucket company is usually what we call a company that receives excess profits to be asset protected and kept away from the business. It's distributed out from the business. Now, if it's a bucket company, it doesn't usually trade. It's not treated as a business. It's really passive in nature. So the legitimacy to have an employee to get salaries is kind of weird because it doesn't run a business. What are they doing those salaries? Because remember, for salaries to be tax deductible, it needs to be incurred in while you're earning the income. So it is a little bit weird when it's passive, like a dividend income from a trading company. You don't really need salaries to do that. Yeah. So the other bit that I might just add as well on that one is in terms of employees getting salaries, family members getting salaries, you probably want to kind of look at why first, because if there is a way that if they work for your business and they work in your business legitimately and you run, let's say, your business through a trust, you don't necessarily have to pay them a salary. If they're doing that, you can issue the profit distributions. Now, but if they work for the business and you run through a company, yes, you can pay the salary, absolutely, as long as it's market rate. You have to make sure that you're not kind of just issuing salaries willy-nilly, because it's not arm's length. You want to make sure that there's market rate in there as well.
Cool. So I'm just
good.
Confirming another question. Cool. All righty. Well, that brings the questions to an end. There was quite a few there, which is cool to see. A bit of interaction, but we might wrap up the webinar there. And just a final thanks to everyone who's tuned in for the webinar today. Thanks